What are the top five attributes of a successful investor that you think are?
Okay. Well, we'll see if we can get to five. But, well, I would say good traits or important traits for being a good investor. Number one, the single most important skill is patience. So I think the thing is that markets have kind of a way of deceiving us because, when you turn on CNBC and you see all those flashing red and green lights and all that, it's inducing the brain to think that you need to act now and you need to act immediately, where nothing could be further from the truth. Buffett always talks about having this punch card where in a lifetime you make 20 punches and each time you buy a stock, you punch it once. So in a lifetime, you'd make 20 investment decisions, which means that if you started investing at 20 and ended at 80, every 3 years on average, you'd make one investment. And that is very hard for most people to do. And so the more you can slow down your investing and the more patient you can be. So the issue is that the time scales over which companies go through change and such is very different from the time scales at which stock markets operate. And so you really have to not focus so much on the stock market and have a lot more focus on the nature of change in businesses and be willing to be in there for a while. And like I told you, for the compounding to work, you don't need to double your money every 3 months. Even if you double your money every 3 years or even every 5 years, that's plenty because, it's just a matter of how many doubles you can get and such. So patience is the number one skill set. The second, I think, important skill would be that if you have run a business before, it's a huge advantage because of the whole interplay between investing and running a business, because it's very important to be able to understand how a CEO thinks and the factors that they are primarily focused on thinking about when they're running the business. And that's hard to get to with spreadsheets and so on. And I think another very important trait for successful investing is to stay within your circle of competence. So I think Buffett always says that it's not the size of the circle that matters, but knowing its boundaries, it's absolutely critical. And Charlie Munger talks about that. He gives a couple of examples. One is he says that if in a small town you bought the McDonald's franchise, you bought the Ford dealership. Ford dealership, gas station not so good. And gas station we leave to the Patels, low-cost operations. Okay, and then you want the best Class A office building, and you want the best residential building, right? So if you've got these 4 assets, and you don't need to own them completely, you could own 20% of each of them, right? So his perspective was that if in Peoria, Illinois, you own these 4 assets, and you just sat on them for your whole life, you would end up probably quite wealthy. And so if you think about it from a modern portfolio theory point of view, you would say, well, you're not diversified, everything's in one geography, et cetera, et cetera. Yeah, but the odds I'd probably still work out. And in fact, he has a friend here in near Stanford, John Arriaga, who all he did was bought real estate within a mile of the Stanford campus. And, I think Arriaga is a billionaire. And so, what is Arriaga's circle of competence? It's this small. So the size of the circle is not relevant. Staying inside the circle is very fundamental. So I think circle of competence is a very important trait. Another important trait is margin of safety. So you buy things for well less than what they're worth. And then I think the final piece would be that what Ben Graham says, that you're not buying a piece of paper, you're buying a fraction of a business. So if I were to think about investing in Google, for example, the question I should ask myself is, if my family had $1 trillion, would I be happy putting 410 billion? Is that what the market cap is right now? 410 billion, right? So if I had $1 trillion, would I be comfortable putting 410 billion into Google? And if the answer is no, then I shouldn't put $10 into Google, right? So the mindset, so many times when people say, what do you think of Apple? And they don't know the market cap of Apple. So my question is, why are you talking to me about Apple? You don't even know what the company is for sale for, So if you're going to invest, at a minimum, you got to know what the entire business is selling for, and would you be willing to put 50-60% of your total family assets, if you had that much, into that business? And if the answer is no, then don't go there, And I would have been willing to do that at Stewart Enterprises, at the pricing I was looking at and all that. In fact, what I would have done, I would have bought a whole bunch of the debt as well too, just to get total control over the situation. So, and then just sit on those cemeteries. That'd be fine. So, you're probably best off never touching Excel. Right? So Excel has nothing to do with investing. So that might be, heresy at Stanford Business School or something. But the way to really look at investing is that when you look at, again, a business like Google or Microsoft or Berkshire, you really have to put yourself in the shoes of the people running the business. And you have to ask yourself, how do they run the business? Do they run it through a set of spreadsheets? Or how do they run it? And I would bet that most of these businesses are run in a manner where the founders or CEOs are really looking at kind of 3 to 5 variables that dominate most of their thinking and outcome and direction. And so as an investor, you've got to hone in on those same variables. So if you can get to the same variables, if you're going to invest in Microsoft, you can get to the same variables that Satya Nadella is using, and Google, you get to the same variables that Larry and Sergey are using, then you're getting very close to trying to figure out what the business might do. And from there, you can extrapolate whether it's underpriced or fairly priced and so on. So that's what I would suggest is avoid the use of spreadsheets and avoid precision thinking.